Welcome on board the gentlemen from Girik Capital. We have with us Charandeep Singh as well as Varun Daga joining in on the show right now. Gentlemen, hi, morning. Charandeep, we were all geared up for a Freaky Friday. Fortunately, one can say thank God it's Friday and the pain from this week at least is going to get over. But tell me, Charandeep, is it going to get a lot worse before it gets any better? Not just for us, but globally at large?
It's hard to predict always, but I must say the headlines are very bad, and indicators seem very bearish. I mean, market participants appear very bearish. People are only drawing worst case conclusions here. This typically happens closer to the end of a fall, and I'm not saying this is an ultimate bottom or something. We are not in the business of trying to predict that, but at least near term, it's the fifth straight week of a fall. Things seem a little overdone and people seem very nervous, and the rhetoric about high inflation, interest rates going up, a lot of that has already been factored in. You've been correcting now since October last year. Typically these corrections, it's very healthy and normal for them to run for 12, 13, 14 months. It tends to flush out excesses. So if you look at the size of the correction, it's just a 15% correction on the Nifty. You've had many of these in the last 10 years, maybe 6 to 8 of them. Of course, in the lower quality and higher risk bucket, many of the smaller companies fall into that category. They've been crushed. So that's the part of the market that's been badly hurt, and that could continue to get hurt. So it's very important to be in the right names. And yes, you could get another 5 to 10% fall in the Nifty worst case. I don't know, maybe not. But I think it's very important to put things into perspective that this is but just only a 15% healthy correction. And it's not, something that's unexpected by market participants. It should happen just to flush out excesses every now and then.
Yeah, absolutely. And it's even in the most roaring of bull markets previously in history, we've seen such sharp corrections. But, investors have short-term memory, so one tends to forget. But Charandeep, tell me, have you been a buyer in this decline?
The answer is no. We've not been a buyer in the decline yet. I think we are waiting for things to play out, waiting for things to stabilize a little. In fact, I must highlight to you that we've been constantly reducing our small cap exposure in the portfolio now for quite some time. Our small cap exposure, just to put things into perspective, maybe our 9% right now in our portfolio, 9 to 10%. And of course, the reason for that is, we have very robust risk management practices at Girik. And, we have a habit and a track record of cutting off risk when it's not going in our favor. It's very important to protect when you're running highly concentrated 20 to 25 stock portfolios, which are much more concentrated than the nearest index. You run much more risk. So it's very important to protect gains that you've made at a time like this. So yeah, to answer your question more directly, no, we've not been buyers as yet, but we're looking like hawks. We've got our eyes open. We're looking for new trends. We're looking for new names. And, I'm sure that in the next 2 or 3 months, you will find several opportunities, maybe in sectors that are new and different from the sectors that performed over the last 5 to 10 years.
Good morning. This is Nayantara. So do you want to tell us what those sectors could be? What are these trends that you have spotted that you're like screening over like hawks?
Right. Okay. So I'll tell you what we've been seeing. I can tell you for the last couple of years, you've seen a great momentum in the commodity names, in names that are, that were really ignored over the last 8 or 10 years. Some of the more consensus names would have been the consumer names, the very high P, high growth kind of names that have done very well. Some of the private banks have done very well in the last 10, 12 years. Some of the consumer names have done very well in the last 10, 12 years. We're not really seeing great trends there yet. But you're seeing much stronger trends and price action in names that have been highly ignored and under-owned for quite some time. In the materials names, the materials companies, the commodity companies, the metals names, the oil and gas names. Sure, they may have also taken a hit in the last couple of weeks. But in general, that's where the trend generally lies in the last couple of years. So, that's the side we're evaluating very closely. And I think in general, when you see such a sharp market fall, when markets recover, you tend to see new sectors emerge. And that's what I meant. We'll be looking out for such trends on our screener to see what could really be doing well in a bad market. And, that's where we'll concentrate our research effort.
Varun, good morning. Nantara here. So go on your website. What I see is, your top holding is what? Reliance Industries over 9%, Infi more than 9%, Bajaj Finance, Bharti Airtel, SBI. These are the top five equity holdings. No Adani names that you will add, looking to add? I'm just asking because the kind of rotation that we've also started to see.
Yeah, no, we do not have any of the Adani names, unfortunately. But we avoided some of those names. But yes, we do have some of the good stocks like Reliance and Infi. We have taken down our Infi exposure to almost 3%. This was last month, and we do hold Reliance and Bharti as our top holdings. So we feel that these companies will continue to do well. They do not have that much effect from inflation, pretty much inflation proof, especially on the telecom front. And we like the retail space also. So we believe that the opening up trades will do well. So Reliance Retail again continues to grow. So and we also felt that being in large caps in these times makes more sense. So we are trying to be concentrated amongst some of these larger names rather than going into smaller and mid caps. So that's how we are trying to concentrate. And again, on Bajaj Finance, also we have reduced our exposure. Yeah, even though we like it fundamentally, but we've taken some, risk management. We are actually right now we're wearing the risk management hat. So for us, it's very important to protect downside because that's our mandate to our investors to protect downside. So even though even if we like things fundamentally, as things starts to look bad, we do start cutting exposure. So we are, for example, we are out of lot of our metal names. In fact, we are completely out of metals. We've reduced a lot of IT because they were going out of our screener. So we do follow a very strict risk management, framework, and we don't go out of it, even though we might have other opinions. But we know one thing, that markets are never wrong and opinions often are. So we try to follow the market.
That's quite interesting, Varun. You've given us a lot of food for thought. So let me pick it up one by one. I wanted to know, when you said that you're going to wear your risk manager's hat and you've eased off or trimmed off from Bajaj Finance, why is that? I mean, is it just a valuation adjustment that you've made on Bajaj Finance, questioning how much more can the stock go up from here?
Yeah, so it's a mix of couple of things. One is it's of course a great company, a great stock. We still continue to own it. We've just trimmed it down. I think a lot of excesses were built in some of these financials name, not just recently, but over the last decade. And some of these stocks were very, very over-owned. And what we saw is when institutions come to sell, it really plays a very technical role rather than purely fundamental. We've seen that in the US, companies trading at 50, 60 times have fallen 60, 70%. It's not that they are bad companies, they're global winners and global leaders, but they've all come to mid-teens multiples. So I think that can happen all over the world, and one needs to take cues from that, because US is the mother market. And even though India has been very resilient, but we've seen a lot of selling from FIIs, and there's always that worry that if there is some kind of if the domestics are not able to support, then it can create more of a technical problem. Having said that, I don't think there's any issue fundamentally, but prices can do what they can do, right? Markets can be irrational, and we got to prepare for that, and luckily we are always watching the market, and we can always come back when things improve. So and also we believe that the new leadership could emerge at different places. So I think having money to deploy when the new leadership emerges is also very important. So when we cut risk and when we reduce position, the idea is not to create cash. The idea is to redeploy that cash when the new opportunities come. So uh, when everybody in the market are looking for stocks that have fallen the least, fallen the most, and stocks that are at 52-week high, we do the other way around. In fact, we would look at stocks that have fallen the least, that is showing strength, and then we would go and do fundamental research there, because a lot of times that's where something new is happening, some change is happening. Maybe a new management has come in, maybe a new product is getting launched, maybe the earnings are accelerating in a very big way. So what we do is, when we reduce risk in some of the older names, we look at some of the new names where we can deploy, because markets are always changing and the old leadership won't remain in the future. So we are looking for new leaders. And that's a very big answer to a small question.
No, it was intended to be a small question, so you have time for a big answer, Varun. But Charandeep, this is quite interesting. I'm thinking that you already have a list drawn out, and we're already keeping a watch on where is this new leadership going to come in from. I have two questions for you, but let's start off with, where do you think the next set of disruptors are going to come in from?
Sorry, I didn't get that question of yours. What do you mean by disruptors?
No, Varun just talked about, he thinks that a new set of leaders will emerge in this market. Yeah. So right. I'm guessing that, there will be some amount of disruption where the old is going to make way for the new. And that's why, that's what I'm talking about when I say disruptors.
Yeah, so, I'll tell you, I'll try to make this, I'll try to explain this in a quantitative manner. So, if you look at destruction, it's always relative also. It's absolute. Right now, you're seeing absolute destruction, but you sometimes continuously see relative destruction. So now, if you look at the banking and financial services component of the Nifty, at peak in Feb 2020, it had gone to close to 40 to 44%. It's already shaved off 10% from there. And that slack has been picked up by the resource names and by IT names. So you've already seen destruction in banking and financial services. So it's possibly likely that some of that may continue, right? Maybe that was too big an overweight. And there are other sectors which were very ignored and least liked, where investors hadn't concentrated their money and efforts, which will pick up the slack. You see these trend changes in index very often. It happens, the cyclical rotation happens every cycle, every large cycle. It happened last time in 2008, and HDFC was 2% of the index, bank, went to 10% of the index. So these things change. ICICI was much higher, it's much lower. SBI was much higher, it's much lower. So I think that destruction is constantly underway. It's been underway for the last 2 years. I don't know what will happen. We don't, very hard to predict what will happen. But I think new leadership, for now has remained in IT. It has been in the resource companies and in the utility companies. That's where you've really seen new leadership in the last 2 years. The utilities, the resource, metals, oil and gas, and in IT. That's what's really picked up the slack. And that's where you've seen value creation for investors. Very strong value creation relative to the destruction that has happened in the financial services space, and maybe to some extent in the consumer space also, in the consumer discretionary, also in the staples.
Right. Charanjeet, I was actually talking about disruptors. I didn't mean destruction. But anyway, I got the point.
I think you probably got the answer.
Also to understand, Varun, from you yeah, I got the answer regardless. Don't worry. Varun, you were talking about, being a little circumspect and being safe at this juncture. You talked about as to how you would want to be in the large caps, the safer boys. I'm just wondering, what is your return expectation at an index level for the year ahead? Because you're seeming and sounding very, very cautious.
No, I mean, don't get me wrong. It's always good to be cautious, but when we do our research and when we take our bets, we're always very bullish. If one has a long-term, 5 to 10 year view on India, I think India is very, very well positioned. History speaks for itself. We've had 42 years of Sensex history. We were just doing that analysis. It's given a 16% compounded return over the last 42 years, which is phenomenal. And what's interesting is 32 out of those 42 years were positive years, and there was only 1 year which had more than 30% negative return, which was 2008. So I think the history is in your favor, and the future, of course, looks good. Yes, in the short term, things can be irrational. That's okay. If somebody has a longer term view, these are great times to start building your portfolio and keep, adding to good companies, good names. And if you have, 5 to 10 years, I think things will be much better, over the mid to long term. So one needs to have that picture in mind. Of course, there is always bad news. There was COVID, then now there's inflation. So if you go back to history, I remember when we started, after that, there's so many events. You had demon, you had GST implementation, a lot of global crisis, but eventually good companies will keep thriving. Good managements have ways to do better. They actually do better in crisis because they take market share from the unorganized guys. And I think that's what the equity markets, we've had people saying that economy is so bad during COVID. Why is your stock market doing well? My answer to that is always that, the stock market has the winner's curse. You're talking about the 500 to 600 best companies in the country who have the best management, best talent. They have access to capital. They are way more organized. They have ability to adapt to technology. So that's why the companies which are listed and which are in the stock market have the winner's curse. So they will continue to do well. All you got to do is find out those winners and write them. And if you get them wrong, cut them early and get out of your losers. I think it's as simple as that. And have a long-term view. I think short-term can always be little here and there, but if one has a long-term approach, it will pay off.
Okay, before we let you gentlemen go, I have one question for you, Charandeep. I remember the last time you folks were here, you told us that there have been instances where you have bought high PE stocks and made money, like with DMart, and how you exited Zomato in favor of Trent. We've seen what's happened with Trent and, in fact, other fashion stocks. You've talked about reopening as well. Still bullish on that, given the high PE, the demand for consumer stocks?
So I think the fundamentals are unchanged. I must tell you. So, as Varun explained very well, we look at things both technically and fundamentally. When I say technically, what really matters to us is how prices move and our risk management hat. So, even if we love a business over a 5-year period and we believe, say, that the IRR there should be 15% per annum, and we believe that prices could destruct themselves because of the way other investors are behaving and how markets are behaving, that you could have serious damage in prices over the next year or two, we're not shy to dial down positions and reduce them. So we've done that in several of our names. I won't take specific names, but in several of our names, we've done that in the recent past in order to protect investor capital.
Okay. It's been great having both of you live with us today. The last 5 trading sessions, boy oh boy, it was not for the faint-hearted. Today we have seen the Nifty go back above 16,000. Great to have both of you here from Girik Capital giving solid advice to all those that are tuning in and how to make volatility their best friend.
Thank you.